Welcome to the deep dive. Today, we're kind of grabbing the cheat sheet for serious investing. We're diving into the bedrock philosophy of value investing.
That's right, using that classic text, Security Analysis by Benjamin Graham and David Dodd, almost a century old now.
Exactly. And our mission today, it isn't just, a history lesson.
No, definitely not. It's more like an intervention. We want to pull out the core lessons, the timeless stuff, to show how these principles from the 1930s could have been, well, a prophylactic, as they might say, against pretty much every big investment mess we've seen since.
Okay, so what ties them all together? I mean, you think about the junk bonds in the 80s, the dot-com bubble, late 90s, the subprime crisis, 2000s, even long-term capital management, the huge hedge fund blow-up. What's the common thread?
It's actually pretty simple. Fundamentally, in every case, investors got laser-focused on how much they could gain, potential upside. And they basically ignored or totally disregarded the potential for, well, total loss. Every single one of those disasters could have been sidestepped if people had just stuck to Graham and Dodd's main rule.
Which is?
The core truth, the thing you got to nail down first, avoiding serious loss. That's the absolute precondition if you want to sustain a high compound rate of growth over time. You have to protect the downside first.
Okay, let's unpack that. Avoiding loss is job one. So we need that fundamental distinction, the one that gets ignored all the time.
Sure.
Investment versus speculation. How did Graham and Dodd define that? What's the cornerstone?
Yeah, it's maybe the most important phrase in the whole book. Super precise, very carefully chosen. An investment. It's defined as an operation that promises safety of principal and a satisfactory return.
Okay, promises safety. That word promises. I mean, in finance, nothing's really guaranteed, is it? It seems impossible.
Right, and that's the nuance. You have to read it carefully. Promises doesn't mean, an ironclad guarantee. Of course not. Some investments will fail. But it implies a high degree of certainty. And crucially, that certainty has to come from deep study, from facts, from established standards, not just hope or market buzz.
So anything that doesn't meet that safety standards
Is speculation, period, by definition.
And when you ignore that, well, that's when things go off the rails. Let's take that Federated Department Stores example. Late 80s junk bond mania.
Right. So Federated, they went through this big leveraged acquisition, and the new company, it was committed to paying $600 million a year in interest.
Okay.
But here's the kicker, the big red flag. The company was only expected to earn about $400 million a year. Graham and Dodd would just scream at that. It completely violates the basic rule of capacity to pay.
You can't get blood from a stone.
Exactly. Creditors, legally, economically, they can't pull more money out of a company than it actually makes.
So zero margin for error, zero safety net.
Precisely. And predictably, less than 2 years later, Federated filed for bankruptcy. The danger signs were all there, plain as day.
And we saw echoes of that later, didn't we? Like with LTCM, using complex models, assuming things couldn't go that wrong.
Oh, absolutely.
Yeah.
Substituting complexity, mathematical wizardry for genuine safety. They ignored the real-world risk, the stuff that doesn't fit neatly into a statistical model.
The dot-com bubble, that felt different. It wasn't about miscalculating earnings cover. It was like earnings didn't matter at all, just pure optimism.
Yeah, that was the perfect storm of capitalizing hope. Purely conjectural future prospects, as Graham and Dodd would say. Take Internet Capital Group, ICJ.
I remember that one.
They put about $350 million into, 47 different internet startups, okay? But in 1999, the market valued ICG itself at, wait for it, $46 billion.
Wow.
Think about that. For that valuation to make sense, you had to assume every single one of those little startups would return, on average, over 100 times their initial investment. It was pure fantasy.
No way that promised safety.
Not by any rational metric. Of course, ICG stock later collapsed, went down to 25 cents a share.
Then there's the flip side, the illusion of safety, which brings us to the subprime crisis. Washington Mutual, WAMU, big respected bank in 2006.
Yeah, but reputation means nothing in this analysis. You have to look at the books. If you actually read WAMU's annual report for 2006, all 194 pages of it.
Which most people didn't.
Let's be honest, no. But if you did, you'd find $20 billion in subprime loans. That was equal to 80% of their entire stockholder equity. 80%.
That's staggering.
It gets worse. The bank basically admitted, buried in the notes, that the only thing stopping mass foreclosures was the steady rise in home prices.
They bet the ranch on the housing market never going down.
Exactly. They bet the entire ranch. So anyone doing a proper objective study would see this did not promise safety. It promised disaster if house prices stumbled.
Which they did. Okay, so safety isn't about what the crowd thinks. Does G&D specifically warn against trusting blue chip status?
Oh, fiercely. The market's always inventing new reasons to value things, often based purely on psychology. People forget history. AT&T, right, the ultimate blue chip. It fell from $494 in 1929 down to $36 in the Depression.
Ouch.
Or more recently, Lucent Technologies, hugely popular with institutions in the late 90s, went from $80 a share to less than $1. Popularity, reputation, those are speculative elements, not analytical proof of safety.
Okay, so rule 1 is avoidance. Protect that principle. Step 2 has to be proactive then. How do G&D investors actually find value? Let's talk intrinsic value.
Right, intrinsic value. It's what a business is really worth to someone who plans to own it, for keeps, not just flip it next week.
Okay.
It's based on the cash flow, the actual money that an owner could expect to receive over the long haul. Totally different from just guessing what someone else might pay for the stock later.
And they stress it's not one exact number, right?
Crucially, yes. They urge you to think in terms of a range of values, not a single precise figure.
Why is that range thinking so key? Doesn't it just add uncertainty?
No, actually, the range is your protection. Because look, our analysis is never going to be perfect, right? We're human. The future's messy.
Sure.
So if you accept you're working with a range, it buffers you against being slightly wrong. If you insist on one exact number and you're off by just a little bit, you might end up overpaying. The range makes the margin of safety possible.
I love their analogy for this. You don't need to know someone's exact birthday to know if they're old enough to vote.
It's perfect, isn't it? It is quite possible to decide by inspection that a woman is old enough to vote without knowing her age. You confirm value exists without claiming you have godlike precision.
Okay.
And once you have that reasonable range for intrinsic value, the margin of safety is just, well, it's common sense. You pay substantially less than the low end of your estimated range.
Why substantially less?
Because if you buy right at your calculated maximum value, even the low end of the range, you haven't left any room for error. Any small mistake in your analysis or just bad luck means you could lose money. Buying at full estimated value brings in a speculative element.
Got it.
Yeah.
Now, a lot of people hear value investing and think buying stocks close to book value. Assets minus liabilities on the balance sheet.
Yeah, that's a common misconception. Graham and Dodd were actually pretty dismissive of book value for stock picking. They called it almost worthless as a practical matter for forecasting prices.
Really? Why?
Because book value is fundamentally backward-looking. It's just an accounting tally of past investments. Intrinsic value is forward-looking. It's about earning power, economic potential.
Okay.
Think about it. 2 car companies, right? Same book value today. One has amazing electric tech, great prospects. The other is stuck making gas guzzlers nobody wants. Their intrinsic values are going to be wildly different, even if the books look similar right now.
So the real strategy is bargain hunting, finding assets cheap wherever they pop up. Can you give some more modern examples of this in action?
Oh, definitely. The Asian financial crisis in 97, 98, that was a classic G&D scenario. Panic selling, everything got thrown out.
Indiscriminate sell.
Totally. So smart investors found incredible bargains in places like South Korea. There was this company, Daikyo Corp, tutoring business, trading for $20 a share.
Okay.
But when you looked at their balance sheet, they had $22.66 in cash per share.
Wait, more cash than the stock price?
Yep. You were literally getting the entire ongoing business, all its future earnings potential for free, plus they were paying you $2.66 a share just to take it.
That's not investing. That's like finding money on the sidewalk.
That's the feeling. That's the margin of safety made tangible. Or think about energy stocks back in 2001. Oil prices were low. Nobody wanted drilling companies.
Right.
A G&D investor wouldn't speculate on where oil prices are going next, but they look at the assets. Companies like Ensco International were trading under $50 a share.
And the assets?
The replacement value of their drilling rigs, just the physical equipment, was estimated around $35 a share. So you had this huge margin of safety baked into the tangible assets, regardless of near-term oil prices.
Okay, so this clearly takes work. It's not passive. This analytical discipline. G&D, admit, is not a hard science, right? Skill and chance are both involved. How do we maximize the skill part, especially now with just oceans of information?
Well, A key is prioritizing the quantitative over the qualitative, especially seductive things like trends or, superstar CEOs. G&D stressed looking at average earnings over a long period, like 10 years. That gives a much more solid base than just looking at the recent trend in earnings.
So that trend line going straight up looks great, but
it rarely lasts forever. Investors get hypnotized by it. Microsoft, perfect example. Phenomenal growth, 1995 to 2000.
unstoppable, it seems.
Exactly. So analysts in 2000 just extrapolated that trend way out, projecting earnings of $1.30 and $1.55 a share. But then, wham, the cyclical slump hits in 01, 02. Earnings drop back to 50 cents, basically where they were in the mid-90s.
Back to the average.
Pretty much the lesson. If growth looks too good to be true, zoom out. Look at the long-term average, like G&D advised. That's your anchor to reality.
Now, Graham and Dodd, back in the 30s and 40s, they complained about a lack of information, a paucity. Today, we have the opposite problem, right? Information overload, a surfeit.
Totally. Drowning in data.
So what's the key analytical tool we have now that they didn't that helps cut through the noise?
Oh, unquestionably detailed cash flow statements. These are indispensable today because, as we saw with messes like Enron or Sunbeam, companies can get pretty creative, let's say, with the earnings statement. They can dress it up.
Accounting tricks.
Right. But the one thing they absolutely cannot manufacture is cash. Cash flow doesn't lie. It's the ultimate reality check.
So a company reports big profits, but the cash flow from operations is low or negative. That's a huge red flag.
Massive. It's probably the most reliable signal that something's wrong, that you need to dig much deeper. Lucent, back when its stock was flying high, they were booking sales as income before they actually collected the money. So the income statement looked fantastic, but the cash flow statement showed the reality. The cash wasn't coming in. That's the kind of thing you look for today. Use the cash flow to find the disconnect, like the WAMU subprime exposure or Lucent's missing cash.
And sticking with those qualitative traps, G&D also warned about giving too much credit to management, this idea of double counting.
Yes, another huge psychological pitfall. Look, a company's stock price already reflects the good earnings that strong management produces. That's baked in.
Okay.
But then investors often add another premium, a separate bump in the price, just for the idea of good management. They're effectively paying twice for the same thing.
That sounds like a recipe for overpaying. Any examples?
Coca-Cola, mid-90s. Roberto Goizueta, the CEO, was treated like a business god. Genius.
I remember the hype.
And because investors had such faith he could grow earnings forever, they bid the stock up to like 45 times earnings, insane levels. But his talent was already reflected in Coke's strong earnings. Paying that extra premium just for the Goizueta magic was double counting.
And when growth inevitably slowed.
The stock went nowhere for about a decade. That genius premium just evaporated. Shows how much emotion still pushes prices around.
Okay, let's wrap this up. Bring it home. What are the absolute essential takeaways from Graham and Dodd that should guide every single investment decision?
2 things. Number 1, an operation only qualifies as an investment if it genuinely promises safety of principle, and that promise has to be based on a rigorous study, on facts, on standards, not hope, not hype.
Got it. Safety first, based on analysis.
Exactly. And number 2, you have to determine that intrinsic value range we talked about, and then you must demand a significant discount to that value, that margin of safety. It's non-negotiable. Always buy with a buffer.
And if we think about why those crazy bargains sometimes exist, like Daikyo trading below cash, G&D had a brilliant way of describing the market itself, didn't they?
Oh yeah, it's maybe my favorite quote from the book. They said the market is not a weighing machine, where value is perfectly and impersonally calculated, like on a scale.
Price equals value, which it clearly doesn't always.
Right. Instead, they said, the market is a voting machine. It's where countless people register their choices day in, day out. And those choices, they're partly of reason, sure, but also partly of emotion. Fear, greed, hope, despair.
A voting machine, driven by often fickle human psychology. Okay, so for you, the listener, here's the final thought, the provocative question. Since we know the market acts like this voting machine, swayed by emotion, is your own investment strategy basically trying to guess how everyone else is going to vote tomorrow?
Are you trying to predict the psychology?
Or is your strategy built on doing the independent, quantifiable work? The analysis needed to figure out that intrinsic value and secure that margin of safety for yourself, regardless of the popular vote.
Yeah.
Something to think about as you look at your sources and plan your next operation. Welcome to the Deep Dive. Today we're tackling the bedrock of many portfolios, fixed value investments. Think bonds, preferred stocks.
And we're going back to the source, really. The 1940 edition of Security Analysis by Graham and Dodd.
An absolute classic, but we're filtering it, looking at it through a modern commentary lens as well.
Right.
So the goal here is to pull out that core philosophy. How do they think about moving from, rigid rules to something more pragmatic, more risk-aware?
And what lessons about safety, yield, and just doing the analysis?
Yeah.
What still really matters for you listening today?
Okay, let's set the scene first, though. Because the world they wrote about, and even when the commentary authors started in the 60s, it was different.
Oh, completely different. If you wanted an investment career back then, you basically worked for a bank or an insurance company. Big institutions.
And products we see everywhere now.
Didn't exist. No zero coupon bonds, no high yield market, what we call junk bonds now. Certainly no RMBSs, those mortgage-backed securities or collateralized obligations that cause so much trouble later on.
Right, the things that blew up in 2008.
Exactly. And forget about fancy tools.
No computers, no calculators even for figuring out yields to maturity. That's hard to imagine.
It was all manual slide rules, maybe? This context, it really shaped Graham and Dodd's initial thinking. Very conservative, very rule-based.
Which kind of set up this conflict, right? Because almost as soon as they published, you had new ideas bubbling up.
Especially from academia, the Chicago School. The efficient market hypothesis.
Which basically said, hey, if markets are efficient, what's the point of all this security analysis anyway? So G&D start with these strict rules.
Extremely strict. Their original definition of investment was very, very narrow.
Okay, break that down. What did an investment mean to them?
Well, it meant buying assets that met really high standards. Conservatism, prudence, and the big one, safety. Above all else, safety.
So it wasn't about how much money you might make.
Not primarily, no. Securities qualified based on their quality. Prospective return was secondary. They even had this absolute rule. Deficient safety cannot be compensated for by an abnormally high coupon rate.
If it wasn't safe enough by their measure, high yield didn't make it okay. It wasn't an investment, it was speculation.
Exactly. Full stop.
And wow, that feels worlds away from today. We slap the label investment on, well, almost anything we buy hoping it'll go up. Stocks, bonds, yeah. But also art, jewelry, vacation homes.
Even crypto. The word speculation has almost vanished from popular use, unless it's really out there.
But that Chicago school thinking, that EMH, it brought in this crucial modern idea, didn't it? The risk-return trade-off.
That was the game changer, the idea that you have to look at risk and return together. A super safe investment isn't automatically good if the return is terrible.
And something risky isn't automatically bad.
If the potential reward genuinely compensates you for the risk you're taking, provided you understand that risk, of course.
So where does that leave us? Did G&D's original rules just get thrown out?
Not thrown out, but they had to evolve. The core insight shifted. Basically, almost any asset could be a good investment.
If you buy it right, know what you're doing, get it cheap enough.
Precisely. And the flip side is just as true. There's no asset so wonderful that it can't be a terrible investment if you overpay or misjudge the danger.
And we've seen painful proof of that. You mentioned the 2008 crisis, those mortgage-backed securities, rated AAA, top quality.
Supposedly the safest things you could buy, besides treasuries.
And then, boom, junk status overnight, wiped people out. It really showed that relying on labels, on someone else's definition of quality, isn't enough.
It absolutely isn't, which actually leads perfectly into Graham and Dodd's next big idea for bonds.
Okay.
Because of that risk-limited upside potential for total loss, they argued bond selection is mainly a negative art.
A negative art. Sounds a bit pessimistic, like you're trying not to do something.
Well, in a way you are. Think about a regular bond. What's your best case scenario? You get your interest payments and your principal back, right? Maybe a little price appreciation if rates fall.
Yeah, your potential profit is capped. You're not getting a piece of the company's blowout earnings like a stockholder might.
Exactly. So, since your upside is limited, the most important thing becomes avoiding the ones that go bad. The defaults. The losers.
Ah, I see. So the process is more about rejecting the bad stuff than picking the absolute winners.
That's the core of it. It's exclusion. Rejection. Graham used a baseball analogy.
Okay.
He said a bond investor is like a hitter who never has to swing. They can let countless good pitches go by good bonds with no penalty. The only time they strike out is if they swing at and connect with a bad pitch, an unsound bond.
So you can say no to lots of decent bonds and be fine. The mistake is saying yes to the wrong one.
Precisely. And this defensive thinking shows up in their four main principles for bond selection. The first one is pretty radical for its time.
Lay it on me.
Safety comes from the issuer's ability to pay its debts, period. Not from the specific collateral, not the mortgage lien.
Whoa. Okay, that cuts against centuries of lending practice, right? Where having the mortgage on the factory was everything.
G&D thought that was a fallacy. They argued that the value of that pledged property, the factory or whatever, totally depends on the business earning money, if the business fails.
The factory isn't worth much.
Exactly. Its value collapses. They hated how companies would list the original cost of the property as if that guaranteed anything. Just marketing, they said.
Substance over form, that's a recurring theme, isn't it?
Absolutely. And it led them to say something pretty counterintuitive. The unsecured bonds debentures of a really strong company are actually safer than the first mortgage bonds of a shaky one.
Okay, that takes a minute to process. Unsecured is safer than secured.
If the unsecured company is rock solid, yes. They famously pointed to Standard Oil of New Jersey's debenture 3s. Unsecured, just a 3% coupon.
Why those specifically?
Because everyone knew Standard Oil was incredibly strong. It would survive any depression. If it could afford to pay 3%, it could afford anything. The lack of specific collateral didn't matter because the business was sound. The legal form was less important than the financial reality.
Makes sense. And the third principle ties into this, about yield.
Right. Yield, especially high yield, doesn't magically equal risk in some precise mathematical way. It mainly reflects popularity or, really, the market's perception of risk.
So a high yield is basically the market saying, okay, this is riskier, so we demand a higher promised return.
Yes. But G&D warned that you, as an individual investor, can't really play that game effectively. You can't self-insure by buying lots of different risky bonds.
Why not? Diversification usually helps.
Because bond losses aren't random, they cluster. When a depression hits, lots of risky companies fail together. Your diversification doesn't save you then, unless you're a massive institution. For an individual, the risk isn't worth the extra yield.
That feels very relevant to modern high-yield investing, too.
It is. If you look at successful high-yield managers today, like Oaktree Capital, their whole philosophy echoes G&D's negative art. Success comes from avoiding the defaults, the blow-ups.
Because one bad bond can wipe out the extra yield from several good ones.
Easily. The gains are limited, the losses can be total.
So G&D really focused on what causes those defaults. What do they pinpoint?
Two main things, really, which are still critical. Too much debt leverage and the company's basic instability.
Instability meaning?
The risk that its earning power could just evaporate quickly. They saw a lot of that in industrial bonds during the Great Depression, 1931 to 33. High leverage plus unstable earnings was toxic.
And the antidote?
Size and dominance. Being big and established provided a buffer, some protection against that instability. It gave companies breathing room.
Now, we have to touch on their warnings about real estate. Reading that section today, it feels almost chillingly prophetic, given 2007.
Absolutely. They were deeply skeptical of the mortgage bond practices of their era, particularly these artificial valuations.
What was happening there?
Promoters would get appraisals way, way higher than the actual mortgage value. G&D cited appraisals 66% higher. This allowed the promoters to keep a slice of ownership, the equity, without putting any of their own money down.
Wow. So the investors took all the risk?
Essentially, yes. G&D called it a sad commentary on the lack of common sense. Basically a way to fool investors.
And they were also wary of certain types of real estate loans, weren't they?
Very much so. Loans on buildings built for a specific purpose, think hotels, garages, maybe even hospitals or churches.
Why those?
Because the building's value is totally tied to the success of that one specific business. If the hotel fails, what's the empty hotel building worth? Not much. They said you have to judge those loans like risky industrial bonds, not like standard real estate.
Okay, shifting gears slightly. What about preferred stocks? They're kind of a hybrid, right?
Exactly. Part bond, part stock. And because they're technically weaker than bonds, the dividend isn't a legal requirement like interest, even if it's cumulative. G&D said they needed an extra layer of safety.
So all the tests you'd run on a bond.
Plus more, they needed a bigger cushion.
How much bigger?
Significantly. For an industrial preferred stock, they suggested earnings should cover fixed charges plus the preferred dividend by at least 4 times.
4 times? And for an industrial bond?
They suggested 3 times coverage just for the fixed charges, like interest. That extra turn of coverage for preferreds was because the dividend comes after tax and after all debt is paid. It's the first thing to get cut in hard times.
That makes sense. It needs that extra buffer.
Yeah.
Okay, one last big concept. the idea of permanent investments. Did G&D believe in buy and hold forever?
Absolutely not. That's one of their most important and perhaps most modern insights. They completely debunk the old idea that you could just buy a top-quality bond and lock it away.
So no, set it and forget it.
No. Their new rule is clear. There are no permanent investments. You have to keep watching them. Periodic review, constant supervision.
Why? Even for the good ones.
Because things change. Even strong companies can hit bumps. Industries shift. A bond's price can start reflecting bad news pretty quickly if you're not paying attention. That price inertia doesn't last forever.
But pulling it all together, the real wisdom from security analysis, at least in this area, seems to be this relentless focus on substance over form.
Exactly. And on logic, not just following arbitrary rules. It doesn't matter what the label says, first mortgage, disinsured, whatever. What matters is, can this company actually pay its debts, especially when things get tough?
It seems like timeless advice.
It really is. And it led them to a very practical conclusion back in 1940 for the average person.
Which was?
Given all the work needed, the analysis, the constant watching, they basically said, for most people with moderate savings, U.S. savings bonds were probably the best bet.
Simpler, safer.
Trouble-free was their term.
Yeah.
Yes, the yield might be slightly lower than corporates, but was that tiny extra yield worth all the effort and risk involved in picking and managing individual bonds? For most people, they thought probably not.
Which leaves us with a really pointed question for you, our listener, today. If managing fixed value investments properly requires this constant analysis, this professional level supervision in modern finance certainly hasn't made it any simpler, does it still make sense for many individual investors?
Right. Is chasing that extra bit of yield from corporate bonds or preferred stocks actually worth the complexity, the time commitment, and the inherent risk compared to simpler, safer alternatives like, say, government bonds or treasuries?
If avoiding significant loss in fixed income demands that much work, maybe for the average person just looking for a reliable income, has the whole concept become more trouble than it's worth? Something to think about. Future earnings. Often there aren't any positive earnings. You move straight to the balance sheet. G&D really prize stocks selling below their liquidating value.
Okay, let's just clarify liquidating value. If a company is a going concern, its value is based on future income, right? So if it's liquidating, what are you actually looking at?
You're analyzing the cold, hard assets. Liquidating value in its, let's say, purest G&D form is often figured out by calculating something like net working capital. You take the current assets, cash, receivables, inventory sometimes, and you subtract all liabilities, current, long-term, everything.
All of them, okay.
And G&D's principle was pretty stark. If a stock sells persistently below this provable liquidating value, then either the price is just way too low or management should immediately liquidate the company, sell everything off, and give the cash to the shareholders.
That forensic balance sheet approach, it seems to support a specific way of thinking about bankruptcy strategies. The sources lay out a typology, defining the investor's end goal.
Yeah, that's a good way to put it. There are broadly two types of situations, but they kind of yield three different outcomes. First, you've got liquidations. This is really the purest G&D exercise. You buy the security hoping the remaining balance sheet assets will support cash distributions higher than the current security price.
So the goal is simple, creating cash at a discount.
Exactly. Straightforward arbitrage in theory.
Then we move into reorganizations, which you mentioned have two flavors. The first one is the grab bag approach.
Right, the grab bag. This situation is one where the bankruptcy produces this really complex mix of cash and various new securities in the company that emerges from bankruptcy. You might get new senior debt, junior debt, preferred stock, new equity, all sorts of things. This involves, frankly, the greatest complexity because the investor has to correctly predict the outcome of these really intense intercreditor disputes.
Intercreditor disputes, that sounds like a legal minefield. Are we talking about different types of bondholders, creditors, all fighting over the remaining value, trying to figure out who gets which new security in the reorganized company?
Precisely. It's exactly that. It's the senior secured bondholders arguing with the unsecured junior bondholders, maybe the preferred shareholders, all fighting over who takes the biggest haircut, who gets the best paper in the new company. The final distribution plan absolutely determines the investor's return. Get it wrong, you could lose everything.
Okay. And the third flavor of reorganization, the polar opposite, is control.
Yes, control. This is where the investor isn't just looking to get securities out, they're actively seeking to seize management control of the reorganized company. They expect their profit to come from actually improving the going concern, fixing the business model, not just selling off assets. You're betting on your operational skills, essentially.
Okay, let's look at a couple of real-life examples here that seem to illustrate this spectrum really well, starting with Texaco back in 1987.
Texaco. That's the classic quasi-bankruptcy.
Right.
And it was really an equity play. Texaco filed Chapter 11, but not because it was actually insolvent, out of cash. It was explicitly using the bankruptcy code as an escape hatch. They were trying to get out from under this massive, crushing $10.3 billion judgment they owed to Pennzoil. It was fundamentally a legal problem, not a broken business.
Right. And Carlyle jumped in, bought a huge equity stake, betting the court wouldn't just wipe out stockholders completely in that situation.
And his gamble paid off, big time. He negotiated a special dividend, a buyback, eventually made something like $1.1 billion, a return over 75%. That scenario is really the G&D ideal. A marvelous business encounters a one-time huge but solvable problem.
Okay, now let's contrast that with Adelphia Communications. You said that's a textbook grab bag case.
Oh, completely. Adelphia involved massive fraud. We're talking $2.3 billion in off-balance sheet loans hidden away.
Yeah.
So the reorganization involved exactly those vicious intercreditor disputes we talked about. A real brawl.
And the outcome there.
Well, those investors who correctly figured out the final capital structure and who bought the really deeply discounted Century bonds near the bottom, they saw incredible returns, over 400%.
Wow. But what about the common stock?
Common stock.
Yeah.
Common stock. Receipts zero. Wiped out completely. And that single data point, Adelphia Common getting nothing while some bonds return 400%, it just perfectly illustrates why understanding capital structure is critical. And also why G&D just rejected market efficiency. The market was clearly pricing sheer terror, right?
Yeah.
Which allowed for the spectacular arbitrage for those who kept their heads and did the analysis. And the very fact that we can talk about, 400% returns in these distress scenarios, it immediately brings up that classic question. If the market is supposedly so efficient, why don't prices just instantly correct these bargains? Why would Texaco stock ever fall far enough for ICANN to make a 75% return?
Yeah, that's the core tension, isn't it, between the G&D philosophy and, well, modern financial theory.
Absolutely. Graham and Dodd fundamentally rejected the efficient market hypothesis, the EMH. They famously compare the market to a voting machine, driven partly by reason, sure, but often largely by emotion. Herd behavior. They didn't see it as a precise weighing machine that instantly figures out true value. They assumed market price is frequently wrong, out of line with intrinsic value. And the opportunity lies in the fact that these gaps, these disparities, they tend to correct themselves over time, eventually.
Okay, so if the market price is often wrong, what's the actual mechanism? What creates the bargain for the distress specialist?
In a word, fear. Fear creates the bargain. When a company hits distress, maybe it misses a bond coupon payment, files for Chapter 11, you get this massive wave of forced sellers.
Yeah.
Think about large institutional investors. Many are bound by their charters, their investment mandates, internal risk policies. They have to liquidate any holding that falls into default or drops below investment-grade ratings.
They're forced to sell. Doesn't matter the price, they just have to get out because of the rules.
Exactly. They have to comply with the mandate. And this huge clamor for the narrow exit doors, it just drives the price way below intrinsic value, even for the most senior, well-secured bonds sometimes. This panic selling creates the precise opportunity the disciplined, unemotional specialist is waiting for. Wall Street, as our source puts it, isn't really a bull or a bear, it's more like a shark, constantly rapidly shifting direction. And the bankruptcy investor kind of lives off these extreme misallocations driven by that panic.
So the saying goes, right? When the spread between risk-free rates and high-yield bonds is wide, meaning the market is super pessimistic about risk, that's when you go fishing.
That's the time. And when that spread tightens up, gets really narrow, meaning the market is maybe too optimistic, too complacent, that's when you stay close to home and mend your nets. Wait for the fear to return.
Okay, let's maybe shift gears a bit to a different kind of complex security. These privileged senior issues. These are things like bonds or preferred stocks that try to combine the safety, supposedly, of senior security with the upside potential of common stock. What were the three main kinds of these profit-sharing privileges that G&D identified?
Right. They outlined three main types designed to give the holder that equity-like upside. First, and most common, is the convertible. That gives you the right to exchange your senior issue, your bond or preferred, for common stock at a set ratio. Second is participating issues. These offer extra income, usually tied to how much dividend the common stock pays out. And third, subscription rights, usually attached as warrants. These give you the right to buy common shares later at a stipulated price.
Okay, on the surface, these sound really attractive, right? You get maximum safety, supposedly, plus potentially unlimited appreciation. Where's the trap? What did G&D warn conservative buyers about?
Well, the trap is kind of twofold, according to G&D. First, they noted that quite often this profit-sharing feature, this sweetener, was most often offered to compensate for inadequate security in the first place. The underlying bond wasn't that great.
Ah, a red flag.
Potentially, yes.
Yeah.
Second, the idea of unlimited profit potential is often illusory. Once the common stock price rises significantly, it pushes the price of the convertible bond, or preferred way up too. Say, a bond you bought at 100 parity now trades at 180 because the stock has doubled. At that point, G&D argued, by holding onto that highly priced bond, you have, for all practical purposes, assumed the status and risks of a stockholder. You're no longer primarily a creditor.
Wait, you mentioned a specific rule they had limiting the advance. Something like 25 to 35%? That sounds incredibly conservative. Doesn't that mean an investor is basically forced to sell right before the really explosive profits might kick in? They'd be abandoning the huge upside potential they bought the bond for in the first place.
It is intensely conservative, absolutely.
Yeah.
But you have to remember, it's entirely consistent with G&D's foundational rule. You must maintain the original premise of your purchase. They stated clearly that the conservative buyer of one of these privileged issues should not ordinarily hold it for more than maybe a 25 to 35% advance from its face value.
Okay.
Once the price moves past that investment range, they argued you must sell it. And crucially, not convert it into stock. Because converting means you are consciously abandoning the original reason you bought it, that priority claim, that unqualified right to get your principal back before stockholders get anything.
So they're forcing the investor to stick rigidly to their initial thesis.
Yes.
Safety first, protect the principal. Okay, that makes sense within their framework. It is interesting, though, the source points out that issues with subscription warrants often showed the best results in market upswings. Why is that?
They often did, yeah. And the reason is because the speculative component, the warrant itself, is separable. You can detach it and sell it separately from the bond. This is a really key practical advantage over most convertibles. The holder can literally cash out the profit by selling the warrant into the rising market, while still retaining their original safer investment position in the bond or preferred stock. It's like, getting to keep your safe cake, but also eat the speculative icing separately.
Got it. That makes sense.
Now, to really safeguard the investor against getting swept away by speculative excitement, even with these senior securities that seem safe, G&D developed a specific tool. It's called the Rule of Maximum Valuation for Senior Issues. It acts as a kind of reality check, a sanity check.
Okay, this sounds really interesting because this rule, it seems designed specifically to detect when things like accumulated preferred dividends or maybe conversion features are leading to these totally irrational valuations, valuations far beyond any true underlying value.
That's exactly its purpose. And the principle behind it is actually pretty simple, conceptually. A senior issue, a preferred stock, let's say, cannot possibly be worth, intrinsically, any more than a common stock would be worth if it occupied that same position, but with no junior securities underneath it. They called this hypothetical security the communized stock.
Okay, so let me see if I get this. You strip away all the other claims below the preferred, the common stock, maybe other stuff. You imagine the preferred shareholder now owns 100% of the entire company. Then you ask, what would that common stock, the communized one, be worth based on the company's actual earnings and assets? And that sets a ceiling. It stops the investor from somehow thinking the existence of common stock below it adds value to the preferred.
You've got it, exactly. It prevents that illogical leap. Let's use their stunning American Zinc example from way back in 1928. It shows the rule in action perfectly. Okay, so American Zinc's preferred stock had $40 per share in accumulated unpaid dividends. In the speculative frenzy of the late 20s, that preferred stock shot up to a price of $118.
$118 a share.
Yep. And simultaneously, the common stock, which was junior to it, soared to $57 a share. Add it all up, this gave the entire company this massive total market valuation of $20.8 million.
$20.8 million, based on what kind of actual earnings?
Based on actual earnings in the prior year of only $481,000.
Okay, wait. $481,000 in earnings supporting a $20.8 million valuation. That suggests the company's maybe worth $4 or $5 million tops, based on earnings, the market was completely disconnected from reality.
Totally disconnected. Now, apply G&D's rule of maximum valuation. If that preferred stock trading at 118 actually represented 100% ownership of the company, if it was the communized stock, what would it be? It would essentially be a common stock earning about $6 per share.
Yeah.
Importantly, this was only after 8 straight years of prior deficits. No earnings before that.
Okay, so a common stock earning $6 a share after years of losses. No sane speculator, let alone an investor, would touch that hypothetical common stock at a price of $118 a share. It makes no sense.
Exactly. No one would pay $118 for that $6 earner. Yet the preferred stock, which theoretically had priority but was still just a claim on that same $6 earner, was trading at 118. And worse, the junior common stock was trading at 57.
So the public was basically valuing the common stock based on some rumor or hope that those accumulated preferred dividends would eventually get paid off somehow. They were treating the unpaid dividends themselves as a source of aggregate value for the whole company, which is just completely backwards thinking.
Absolutely backwards. The unpaid dividends, G&D pointed out, they merely affect how the total value pie gets divided between the preferred shareholders and the common shareholders. They don't increase the size of the pie itself. The rule of maximum valuation helps you detect exactly this kind of irrationality, which is often driven purely by market enthusiasm and speculation, not logic. Hashtag #DanHtake_outro.
Wow. Okay, so we've covered quite a bit here. Graham and Dodd's really strict, almost counterintuitive definition of investment, the types of opportunities created in the chaos of distress, the very conservative strategies for handling those privileged securities, and this vital rule of maximum valuation designed specifically to curb that speculative frenzy. I think the overarching message, really, across all these sources, seems to be the absolute need for rigorous, unemotional, numbers-based judgment.
I think that's right. And the principles of Graham and Dodd, they remain completely timeless. Why? Because the subject they were ultimately studying, investor behavior, that remains constant. Investors are still human, still subject to greed, fear, herd behavior. It doesn't really change. And so the market constantly provides opportunities for true contrarians, for those who can overcome emotion and stick strictly to the numbers, especially on the balance sheet.
And that leaves us with, maybe, a provocative, teasing thought for you to consider. Graham and Dodd's most famous disciple, Warren Buffett, he famously chose not to follow Graham's own strict advice back in 1951. Graham advised waiting for the Dow Jones to decline below 200, a rule that had actually held up for 55 years. But Buffett concluded that in that specific instance, maybe this time is different, and he moved forward with his investments anyway. So our deep dive today really suggests the enduring challenge for every investor. How do you know? When you're faced with a huge investment opportunity, maybe one that looks expensive or flies in the face of old rules, are you exhibiting Buffett's rare foresight and audacity, or are you simply surrendering to the exact bull market psychology that Graham and Dodd warned us all against? That, perhaps, is the fundamental challenge of mingling your blood and judgment, as they put it. Something to think about. Welcome to the Deep Dive. Today, we're getting right into, well, maybe the biggest question in finance. How do you figure out what a common stock is really worth?
Yeah, what's its intrinsic value? We're going beyond the headlines today.
We're focusing on the real sources of wealth for business owners.
And we're definitely leaning on some foundational work here. Think Benjamin Graham, David Dodd, their classic security analysis.
Right, from way back in 1934, still relevant.
Absolutely. It really set the stage for thinking about stocks like you think about bonds looking for definable value based on, future returns.
And you, our listener, you've sent in a lot of great material about this exact problem. So our mission today, let's unpack common stock investment theory. We'll focus on two main things.
Okay.
First, finding those true owner earnings, what Graham called earnings power.
Right.
Today, we mostly call it free cash flow, or FCF.
Got it. And second,
the dividend factor. It's surprisingly critical and honestly pretty paradoxical in how we value things. Okay, let's dive into that first part, free cash flow, FCF. The sources we looked at use a great analogy, I think. The corner variety store.
Yes. It's very intuitive. So imagine you own that store.
Okay.
Money comes into the cash register all day. That's your revenue. Simple enough.
Right.
But you immediately have to take cash out just to keep the place running, right? You need to restock the shelves, pay the rent, meet payroll, fix the leaky roof.
The essentials, just to keep things going as they are.
Exactly. Those are your maintenance capital expenditures. Cash needed just to maintain the current level of business, the current profitability.
And whatever's left over, the cash the owner can actually put in their pocket or maybe use to, add a new aisle, that's the free cash flow.
That's it. That's the owner's real reward.
Yeah.
FCF is that surplus cash after all the necessary operating costs and those maintenance expenses are paid.
Graham and Dodd called it earnings power. Makes sense.
It does. Because it's really that all future returns come from.
Yeah.
Whether that's dividends paid out to you, or stock buybacks, or even reinvestments that hopefully boost future FCF.
It's different from bonds, then.
Completely different. Bonds promise you fixed, contractual payments. Stocks, well, any return you get from a stock ultimately has to be drawn from this pool of free cash flow. No FCF, no sustainable return. It's that simple. Now, what's really interesting and frankly more complicated today is figuring out just how big that well of cash actually is.
Why more complicated now?
Because historically, say back in the 30s when Graham and Dodd were first writing, valuation was maybe a bit more straightforward because the focus was heavily on tangible assets.
You mean physical stuff. Railroad tracks, factories, machinery.
Exactly. Things you could see, touch, measure easily. A 1930s company's balance sheet often reflected the real core of its earning power. If you bought a railroad, the value is pretty clearly tied to the tracks, the land, the locomotives. But, and here's where it gets really interesting for us today, the market is dominated by service firms now. Think Microsoft, Oracle, ADP.
Companies where the value isn't necessarily in buildings or machines.
Precisely. Their immense value often lies in intangibles.
Things like software code, brand reputation, customer lists, a strong portfolio of products.
Yes, all of that. Things that might have cost a fortune to develop or acquire, like maybe a huge customer base or a famous brand name. But critically,
What?
these incredibly valuable assets often don't show up on the balance sheet at their true current worth. Or sometimes, not at all explicitly.
So analysts have to dig deeper.
They absolutely do. You have to figure out where the real capital, the real engine of future FCF actually resides. And this whole shift, it leads us right into why standard accounting reports need, well, careful adjustment.
Which brings us nicely to Section 3. Because GAAP generally accepted accounting principles, it was kind of built for that older tangible world, wasn't it?
Largely, yes.
So to find those true owner earnings, that FCF, we often need to sharpen the pencil quite a bit. Why isn't the standard GAAP net income figure good enough on its own?
Because GAAP net income is fundamentally an accounting profit. It follows certain rules and conventions, but it doesn't always reflect the actual cash generated or available to the owners.
So it's not necessarily cash in the bank?
Not always, no. To get to real FCF, you need to make some key adjustments. It's like excavating the real cash flow from the accounting statements.
Okay, walk us through it. What's the first step in this excavation?
Step 1. You start with the reported net income, and then you add back non-cash charges.
Non-cash charges, like what?
The big ones are depreciation for tangible assets like machines wearing out and amortization, for intangible assets like the value of a patent decreasing over time.
Okay.
These are expenses on the income statement that reduce reported profit, but no actual cash leaves the company when these are recorded. They're based on past spending and accounting rules.
So if a company buys another company and pays a premium, that goodwill gets written down over time, hurting reported earnings.
Exactly. That amortization of goodwill is a classic non-cash charge. You add it back because the cash wasn't spent this year.
Got it. Add back depreciation and amortization. What's step 2?
Step 2. You have to subtract maintenance costs. And this is crucial. You need to estimate the actual cash spent just to keep the existing business running smoothly, maintaining the current level of profit. This is often called maintenance CapEx.
And this is where it can get tricky, right? Our sources mention companies sometimes blur the lines here.
They absolutely do. It's a common area for, let's say, management discretion. Sometimes spending that's really just replacing old equipment gets labeled as growth spending.
Which makes the FCF look bigger than it really is.
Correct. It exaggerates the cash truly available to owners or for real expansion. It paints a rosier picture.
Okay, so that definitely feels more like an art than a science. Which probably also applies to step 3, adjusting for management biases.
It's very much an art, yes. You have to be skeptical and look closely at management's assumptions. Are they being too optimistic about pension fund returns, making pension costs look lower than they might really be?
Or underestimating future healthcare costs.
Right. Or how about stock options? Are they fully counting the cost of options granted to executives? Sometimes companies buy back stock at high prices, mainly just to offset the dilution from those options, which isn't really a return of capital to shareholders.
Subtle ways to boost the reported numbers. And the last step. Step 4.
Step 4 is about sniffing out profits that aren't really cash-based at all. Profits derived purely from accounting rules. Identify accounting-derived profits.
Like the Enron example.
That's the classic, though extreme case. They booked future profits from long-term contracts as current income, even though the cash wouldn't arrive for years, if ever. But it happens in less dramatic ways, too. Think about banks or insurance companies. They have significant leeway in estimating future loan losses or insurance claims. Those estimates directly impact current reported profits, but the cash reality might be very different down the line.
Wow. Okay, so these adjustments can make a huge difference. The Mohawk Industries example is striking. JAP earnings were, what, $6.70 a share?
That's right. But when you did the FCF calculation, adding back significant non-cash amortization charges from past acquisitions.
The real free cash flow was closer to $9 per share.
A massive difference. Over 30% higher. Suddenly, a stock that looked maybe a bit pricey based on JAP earnings seemed potentially very attractive, trading at less than 7 times its actual free cash flow.
That really highlights why digging for FCF is so important. It can fundamentally change your view of a company's value.
And, to really appreciate why this conservative focus on FCF is so vital, it helps to look back at history. Before the crash of 1929, the traditional sound approach to stocks was pretty straightforward.
What did that look like?
It was based on a kind of threefold idea. First, you wanted an established, reliable dividend. Second, you needed stable earnings that were comfortably higher than the dividend being paid out.
Covering the dividend easily.
Right. And third, you looked for satisfactory backing by tangible assets. Crucially, this meant avoiding watered stock.
Watered stock, what's that exactly?
It's an old term. Basically means the assets listed on the company's books were inflated, valued much higher than their actual real-world worth. Think overvalued patents or property.
So, avoiding financial fiction.
Precisely. The analyst back then was mainly focused on defense spotting weaknesses, comparing similar companies based on past performance, looking too hard at future prospects. That was seen as speculation, not investment.
Okay, but then things changed dramatically leading up to 1929. The new era theory took hold.
Oh, completely, and it was catastrophic. This theory had one core, very dangerous idea. The value of a stock depends entirely on what it will earn in the future.
Everything else didn't matter.
Pretty much. Dividends, unimportant. Asset value, irrelevant. Past earnings only mattered if they showed a trend of future growth, ideally an accelerating one.
That sounds familiar. Like some market narratives we still hear today focus solely on future potential.
It's incredibly similar.
Yeah.
And it was toxic because it completely blurred the line between investment and pure speculation. And crucially, it taught people to ignore the price they were paying.
If the future trend looked good, price didn't matter.
That was the logic. If earnings were rising, who cared if you paid 10 times earnings or 20 or even 35 times earnings? The assumption was the trend would go on forever. So stocks earning maybe $2.50 a share were bid up to $100. Any sense of a reasonable upper limit on price just vanished.
And we saw the tragic result in examples like that hosiery company, Schletter and Zander.
Right. They were the perfect new era stock.
Yeah.
Earnings trend, up from 1925 through 1928. Exactly what the speculators craved.
But the trend didn't last.
Of course not. That assumption that a trend is permanent is almost always flawed. By 1930, huge losses. By 1931, the company was liquidated. Common stockholders wiped out completely.
A brutal lesson.
It shows that believing a rising trend alone justifies any price is just a recipe for disaster.
That powerful lesson ties back nicely to the dividend factor. Because how a company uses its FCF, paying it out or keeping it, creates this inherent conflict, right, between management and the owners, the stockholders.
Absolutely. Management often favors a more conservative approach. They want to plow back earnings into the business.
Why? What's the argument for keeping the cash?
Well, the arguments are usually about strengthening working capital, maybe funding expansion, or sometimes fixing old problems like that watered stock issue, paying down debt, or cleaning up the balance sheet. Think Woolworth or U.S. Steel in the old days.
But the market, the typical investor, doesn't always buy that argument.
Generally, no. The market tends to be skeptical. Historically, and even today, investors often prefer the dividend now. You usually see stocks that pay out a larger portion of their earnings selling at higher valuations than similar companies with the same earnings power but lower dividend payouts.
And history seems to show that hoarding cash, even huge amounts, doesn't offer the protection management thinks it does.
That's the paradox. Look at Atchison Railway back between 1910 and 1924. They were earning over $12 a share on average, but kept paying out only a $6 dividend.
So they kept half the profits.
Right. They built up this enormous surplus, but when the Great Depression really hit hard, poof, that huge pile of retained earnings didn't prevent a complete loss of income for shareholders in 1932. The dividend was cut entirely.
And U.S. Steel, a giant of its time, had a similar story.
Even more dramatic. Between 1901 and 1930, U.S. Steel accumulated something like $1.25 billion in undistributed earnings, an absolutely staggering sum back then.
You'd think that would provide a massive cushion.
You would. Yet, it only took about 18 months of a severe downturn, early 1931 to mid-1932, for them to suspend the common stock dividend completely.
Wow. So what's the core lesson there?
It really illustrates the heart of this dividend paradox and the risk that comes with just letting management decide what to do with the cash.
So the idea is that a dollar paid out as a dividend is actually worth more to the shareholder than that same dollar kept inside the company.
Often, yes.
Because paying it out removes the risk that management will either misspend it on poor projects, acquisitions that don't work out, or just let it sit there until the next crisis eats it away.
That's exactly the argument. Experience suggests that reinvested profits frequently fail to generate a proportional increase in future earning power. That retained dollar often doesn't work as hard for the shareholder as management hopes.
And thinking about today, you have to wonder about some of the tech giants sitting on mountains of cash. Are they potentially falling into the same trap, assuming that cash hoard makes them invincible to disruption?
It's a very relevant question. Disruption can happen much faster now than an economic contraction did in the 1930s. History suggests caution about relying solely on a large retained surplus. Given all this instability, both historical and modern, we need maybe some updated principles for sound stock investing today. The sources suggest a few key ideas. First, because individual companies can be volatile, you need group operation. Diversification.
Spreading the risk. Makes sense.
Second, fierce selectivity. You still have to pick individual stocks carefully. Don't just buy the market blindly.
Okay.
And third, acknowledging that the future does matter more than perhaps it did in 1934, we need to put more effort into assessing the future outlook. But, and this is a big but, with extreme caution.
Right, because trying to predict the future often leads investors straight back to chasing those elusive growth companies, the ones that seem poised to expand forever.
And that immediately brings back all the speculative dangers we talked about from the new era.
It's hard to pick those winners, isn't it?
Incredibly hard. Most companies seem to follow a kind of life cycle, right? They struggle initially, then maybe have a halcyon period of rapid growth, but eventually they mature and growth slows down. Maybe they hit supermaturity.
So you risk either buying too early, fooled by temporary success, or buying too late when the best growth is already over.
Exactly. You might get deceived by a flash in the pan, or you might buy an established giant just as it's hitting market saturation. And here's the really crucial point. Even if you knew for certain that a company would grow rapidly.
Which you never do.
Right. But even if you did, figuring out what's a fair price to pay today for that future growth is almost impossible. How much premium should you pay? That calculation itself becomes highly speculative.
Which is why, perhaps, the safest anchor, the most reliable principle remains Graham's idea of the margin of safety.
Absolutely. That's the bedrock. The margin of safety isn't about predicting the future perfectly. It's about the price you pay. It's the discount.
The difference between the market price and the company's real underlying value.
It's minimum intrinsic value, yes. What a knowledgeable, prudent business person would pay for the whole company if buying it privately.
And how do you find that margin?
Two main ways, traditionally. One is to buy good companies when the entire market is depressed, like during a crash or a bear market. Everything's on sale then.
Easier said than done psychologically.
Very true. The other way, maybe more consistently applicable, is to find individual stocks that are undervalued even in a normal market. Often these are solid, long-established, well-financed companies that the market is just ignoring.
Why would the market ignore them?
Usually because they lack that exciting speculative growth story. They're seen as boring, maybe mature. But if they're generating solid FCF and selling cheap relative to that FCF, that's where the margin of safety lies.
And, if we circle back one last time to that dividend paradox, it actually suggests a way towards maybe healthier valuations overall.
How so? Well, imagine if shareholders actually asserted themselves more. If retaining earnings wasn't just an automatic, arbitrary decision by management, but something that required explicit justification and maybe even shareholder approval.
So companies would have to make the case for keeping the cash.
Exactly. You might see more variable dividends fluctuating more with actual earnings rather than this often failed attempt by management to keep dividends artificially stable by hoarding cash in good times. More transparency.
Which could benefit the average stockholder more in the long run.
I think the argument is yes, it would. It makes management more accountable for how they use owner capital. Less hoarding, perhaps better allocation.
Which leads us right to that final provocative thought we wanted to leave you, the listener, with. It's the ultimate paradox of valuation that stems from everything we've discussed.
The idea that
Value is increased by taking away value. It sounds completely backward, doesn't it? But think about it. The more the stockholder subtracts in dividends from the capital and surplus fund,
taking cash out of the company,
the larger value he places upon what is left. Because that dollar paid out is certain, it's yours. The dollar kept inside carries the risk of mismanagement or future irrelevance.
It forces you to really consider what value means. Is it the accounting number on the books or the reliable cash flow you actually receive?
Something for you to definitely mull over next time you're looking at a financial report. Remember that paradox. Taking cash out can, counterintuitively, make what remains more valuable. Focus on that free cash flow. That ultimately is king.
Today, we're undertaking a truly foundational deep dive. We're getting into the heart of common stock valuation.
Yeah, we're cracking open, the classic instruction manual for investing.
The principles that really established modern value investing. We want to figure out how to decode earnings.
And crucially, how to separate genuine investment from, just speculation.
And the source material for this? It's fascinating. We're going back.
We are. Right back to 1934. Part V of security analysis.
Wow, 1934, so deep in the Depression.
Exactly. The authors were writing in a market that was absolutely crippled, just shattered confidence.
Which must have forced a certain kind of clarity, right?
It really did. Their mission then, and honestly it's still our mission now, was crystal clear. Meticulously analyze those income accounts.
To find what?
To estimate the true sustainable earning power of a business. What it can really earn consistently.
That's the only way to know if a stock is actually undervalued.
Precisely. It's the bedrock.
Okay, let's unpack this. Because before this focus on earnings, investors looked mostly at assets, right? Net worth.
That's right. The balance sheet was king. Tangible stuff, book value.
But then came this big shift, moving valuation primarily to capitalized earning power.
And while that sounds maybe more sophisticated, it immediately brought in, as the text says, a multiplicity of added hazards. Huge risks.
Because you're relying so heavily on just the earnings statement.
Exactly. It's just one criterion, fundamentally less dependable than looking at assets. And it changes rapidly, radically sometimes.
And it can be manipulated.
Oh, absolutely. It's supremely susceptible to, let's say, misleading presentation. Creative accounting.
Which leads us right to that simplified Wall Street formula we still see everywhere.
Yeah.
Price equals current earnings per share times some kind of multiplier.
The quality coefficient, they call it.
Right. But the huge warning here, even back then, was that this quality number, it often comes directly from the earnings trend itself.
Which is completely circular logic.
Yeah. You're using the past trend, which might be dodgy, to justify the multiple you slap on today's earnings.
It makes no sense when you break it down. And management, they have a toolkit for playing these games.
The original text flags 4 main ways they could manipulate EPS, and 2 really jump out, involving something called the surplus account.
Yes, the surplus account. It's a bit of an old term, maybe, but the concept is vital.
Okay, break that down simply for us. What is the surplus account?
Think of it less like cash in the bank and more like the company's accumulated savings jar. Or maybe it's long-term memory. It holds retained earnings, capital reserves.
So stuff outside the normal year-to-year operations.
Exactly. It's where management could quietly park unusual gains or losses, or maybe write off mistakes from past years, keeping them off the current income statement.
So manipulation happens when they start moving big non-recurring items into that account or out of it.
Precisely. To basically smooth out or inflate the current year's reported net income.
Got it. So if our goal is to find the true, ordinary operating result, what the company should earn year after year, the analyst's job is basically surgery.
It is. You have to segregate. Find those special non-recurrent items and cut them out of the picture.
Okay, let's see an example. How did this play out historically?
Well, a classic one from the text is U.S. Steel in 1931.
Okay.
They reported net income, but buried in there was nearly $20 million of special income.
Special income. From what?
Mostly from selling off some unrelated investments they had in public utilities.
Wait, so let me get this straight. Their actual core steel operations lost money, about $6 million.
That's right, an operating loss.
But by selling these unrelated assets and calling it income, they reported a net profit of $13 million.
You got it. Made the whole company look profitable when the main business was bleeding cash.
That's incredible. And you can see the lineage to today, right? All the adjusted EBITDA and pro forma numbers companies push.
It's the exact same impulse. Get you to ignore the messy reality of operations and focus on a sanitized number. They still want to pump up that quality coefficient.
Okay, but then there's the flip side. The text calls it the most vicious type of accounting manipulation. That's when they charge losses directly to surplus, like big write-downs.
Yes, excessive write-downs of inventory or receivables.
Why is that vicious? Isn't writing down bad assets conservative?
But it's about the intent and the effect. By charging that big loss straight to the surplus, that memory vault, it bypasses the current year's income statement completely.
Okay, so it doesn't hurt this year's reported profit.
Right. But here's the vicious part. It creates an artificially low-cost basis for those assets on the balance sheet.
So when they eventually sell that inventory or collect those receivables next year?
Bingo. The reported profit in the following year is artificially inflated because the starting cost was artificially low.
So a genuine $200,000 profit might suddenly look like $600,000.
Right. Easily. All because of a quiet accounting entry against surplus the year before. It's stealing from today's balance sheet to juice tomorrow's income.
And the same kind of game applies to fixed assets, too. Depreciation and amortization.
Absolutely. If a company takes a huge, excessive write-down on its factories or equipment, again, charged to surplus,
It lowers the asset value on the books,
which means future depreciation charges are permanently reduced.
making future reported earnings look better automatically.
Yes. The text calls it an inexcusable subterfuge. American Locomotive Company did this a huge property write-down, slashed their future depreciation to like 40% of what it used to be.
Instant earnings improvement, but it's just shuffling costs through time. It's not real operational improvement.
Not at all.
And this gets even more complicated in industries like oil and gas or mining, doesn't it? With things like depletion allowances and drilling costs.
Oh, definitely. Extractive industries are notorious. Accounting policies for depletion or intangible drilling costs can shift.
How so?
Take Marland Oil back in 1926. They changed their policy on intangible drilling costs. Instead of expensing them immediately hitting current earnings hard, they started capitalizing them, spreading the cost out over years.
And the impact.
Massive immediate increase in reported profits overnight without drilling one extra barrel of oil more efficiently.
Just changing an accounting rule.
Yeah.
And even with consolidated reports, subsidiaries can muddy the waters too.
Yes, even if the parent company combines everything, a parent might be having a bad year.
Okay.
So it tells its profitable subsidiary to pay out an unusually massive dividend, drawing down the subsidiary's past profits, its retained earnings.
And the parent books that huge dividend as current income.
Exactly. Stabilizes its unreported earnings, makes things look smoother than they are.
There was that crazy railroad example too, wasn't there, where they literally just passed money back and forth.
Yes. Western Pacific Railroad in 1925. A truly extreme case, but illustrative.
What did they do?
The parent company wanted to report $5 per share. The actual earnings were closer to $2.
Yeah. Okay. Quite a cap.
So the parent donated $1.5 million to its operating subsidiary's surplus account.
Donated it.
Yep. Then it immediately had the subsidiary declare that exact same amount as a dividend back to the parent.
No way.
Yes way. And the parent reported that dividend as current earnings. They basically conjured $3 per share out of thin air, purely for appearances.
Brazen.
Yeah.
Shows you really have to look past the headline numbers.
Always. So if we strip away all this accounting fog, all these potential games, what are we actually trying to find?
Right. Back to the core principle.
We need the true concept of earning power. And that rests on two things.
Okay.
First, the company's average earnings over a decent period several years, not just one snapshot.
And second,
A reasoned, logical expectation that this average level of earnings can actually be, approximated in the future. It has to be sustainable.
that averaging part is crucial, but stability matters too, right? You can't just average wild swings.
Absolutely critical point. The average has to represent something real, not just be a mathematical abstraction.
Like the comparison in the text. S.H. Crust, the retailer. Their earnings varied, sure, but moderately. the average meant something.
Right. That average reflected genuine, relatively stable earning power.
But then you had Hudson Motors. Maybe the average EPS over 10 years looked okay.
But it was an average of 10 wildly different numbers. Boom years, bust years. That average told you almost nothing about the next year. It was useless for prediction.
And we have to be so careful about just projecting trends forward, especially good trends.
Oh, the siren song of the rising EPS chart. Company A's earnings are up 20% year after year. It must continue.
But it rarely does indefinitely.
Never. Competition rushes in, markets get saturated, the law of diminishing returns always kicks in, no tree grows to the sky.
Which is a big reason why many really sharp investors today, like, say, Chieftain Capital Management, focus less on reported earnings.
And much more on free cash flow, FCF.
Explain that again, FCF is.
It's the cash flow generated by the operations after you subtract the money the company needs to spend just to maintain its business, the capital expenditures.
And why is that a better metric, potentially?
It's just much harder for management to manipulate. Accounting rules offer lots of leeway for reported earnings, but cash, well, cash is cash.
It shows what's actually left over for shareholders.
Exactly. Cash to pay dividends, buy back stock, make smart acquisitions, or pay down debt. It reflects the real financial health in a way earnings sometimes obscures. The cash flow statement often flags problems hidden in the income statement.
Okay, so we've looked at income quality. What about the company's structure? Debt leverage.
Huge factor. Using debt senior securities can be great. It provides leverage, potentially boosting the return on the common stock.
If it's done safely.
That's the giant caveat. The text warns very strongly that too much debt makes the entire capital structure speculative.
Even if the underlying business is solid.
Even then, you can have a wonderful business generating good cash flow, but if it's drowning in debt, the common stock becomes incredibly risky. A small dip in earnings can wipe out the equity holders.
So the quantitative work is intense. Digging into earnings, cash flow, debt. But that's not the end of the story, is it?
Not even close. Here's where it gets really interesting. After all that number crunching, you have to do what the text calls a qualitative survey of the enterprise.
Okay, qualitative, meaning?
You have to step back and look at the bigger picture, ask different questions, like how predictable is this industry? Is the future of this specific business reasonably foreseeable?
What about the company itself?
Yeah.
Inside.
How strong is the corporate culture? Is it innovative, stagnant? And maybe most importantly, can you trust management?
Trust them to do what?
To act in the best interests of the shareholders. To maximize long-term per-share value.
Because sometimes they have other priorities.
Oh, frequently. Some managers genuinely seem to believe it is their company. They run it to build an empire, gain prestige, satisfy their ego.
Like that famous Comcast bid for Disney back in 2004.
Classic example. Brian Roberts wanted Disney badly. But analysts looked at the deal and said, wait, this all-stock offer would crush Comcast's free cash flow per share.
So good for the CEO's ambition, maybe, but bad for the actual owners of Comcast stock.
Potentially, yes. You, as the investor, have to spend real time figuring out what actually motivates this management team. Is it alignment with shareholders or something else?
This qualitative stuff feels crucial, but maybe harder, less formulaic.
Much harder. And it leads right into why investing is so difficult, even if you understand all these principles intellectually.
The human element.
Exactly. The text implicitly points to, and later value investors explicitly state, 3 big human frailties that trip us up.
Okay, what are they?
First, simple aversion to boredom.
Boredom?
Yeah. Let's be honest, meticulously analyzing financial statements, reading footnotes, comparing companies year after year, it's tedious work.
Definitely not glamorous.
So we get bored. We crave action. We jump out of the detailed 10K analysis and chase the hot stock tip or the latest market fad instead of doing the necessary grinding homework.
Okay, that makes sense. What's second?
Emotions overwhelming reason. Fear and greed, basically.
The classics.
When a stock price is soaring, we feel like geniuses. We get overconfident, ignore risks. When it's plunging, we feel stupid, doubt our analysis, panic, and sell at the bottom.
We let the price movements dictate our feelings and decisions instead of our research dictating our actions.
Precisely. And the third, just plain old greed.
Wanting too much too fast.
Right. It drives the endless search for shortcuts, for get-rich-quick schemes, for complex trading strategies that promise impossible returns, instead of focusing on the patient, often slow, compounding of value through careful investment.
Which explains that timeless observation.
But the stock market in the short run is a voting machine rather than a weighing machine.
It reacts to popularity, sentiment, psychology.
Much more than it reacts to the underlying facts and figures you just spent weeks carefully weighing.
So, wrapping this up, the core message from this deep dive seems pretty sobering. Stock investing is risky, inherently.
It is, given all the uncertainties, the potential for manipulation, the psychological pitfalls.
Success isn't just about research, though that's essential. It also requires strength of character.
Absolutely. Patience, discipline, the emotional fortitude to act independently, often against the prevailing crowd's sentiment, to buy when others are panicking and be skeptical when others are euphoric.
So what does this all mean for you, the listener, practically? How do you use this?
Well, it means you have to set a very high bar for putting your capital at risk, a high hurdle rate.
Like demanding a higher potential return.
Exactly. We often suggest aiming for something like a 15% expected annual return from an investment, significantly higher than the general market average.
Why so high?
To build in a significant margin of error, you have to assume that some of your analysis, no matter how careful, will be wrong. The future is uncertain. A high required return gives you a buffer against mistakes and bad luck.
Makes sense. Protect your downside.
Always.
Okay, finally, let's leave you with a provocative thought, something to chew on. It's about finding true bargains.
Right. Forget just looking at the price per share. Is it $5? Is it $50? That often tells you very little about whether it's actually cheap.
The market gets fixated on that nominal price.
It does. But the true speculative opportunity, the genuine low-price stock, the potential multi-bagger, isn't defined by its share price.
What defines it then?
It's defined by its small aggregate market value. The total price tag for the entire company, its market capitalization.
Compared to what?
Compared to its tangible assets, especially its liquid assets, and the underlying size and potential of its core business.
Ah, so if you can buy the whole company for less than its readily available cash and assets, and the business itself is just temporarily depressed.
Exactly. That tiny overall market cap gives you massive potential leverage. If and when conditions improve even slightly, the stock price can multiply dramatically. That's real bargain hunting.
Not just chasing stocks under $10 because they feel cheap.
That's often just chasing junk. The real value comes from understanding the total enterprise value relative to its assets and earning power.
So the challenge for you is this. Take one stock you currently own, ignore its price per share for a moment. Instead, look up its total market capitalization. Then compare that number to its net liquid assets, its tangible book value. See how they stack up. It might surprise you.
Until next time, keep digging. Okay, let's unpack this. We are diving deep into the foundational principles of investment analysis from Graham and Dodd, and specifically, we're focusing on something often ignored, the balance sheet.
Right. Sounds a bit strange, doesn't it? In today's world, everyone's obsessed with growth, quarterly earnings, and we're looking back to 1934 at basic accounting.
But there's a good reason. Our mission today is really to get what Graham and Dodd meant by thorough analysis. How do they actually calculate intrinsic value using assets?
And crucially, why focusing on that balance sheet can, well, protect investors like you from some really spectacular failures. It's all about learning from security analysis.
Okay, so that distinction they make right at the start seems key.
Right.
Investment versus speculation.
Exactly. They drew a very clear line. An investment operation, they said, is one that, after thorough analysis, promises safety of principal and a satisfactory return.
Anything else?
Anything failing one of those three pillars is, by their definition, speculative.
That really makes you think, doesn't it? Especially today. If you buy a stock just because you think the price will go up, hype or momentum.
But you haven't done that analysis ensuring safety. Are you actually investing? Or just speculating? That's the core question they pose.
So how does this thorough analysis actually work? It's all aimed at finding the intrinsic value, right?
Yes. And they define that as the value justified by the facts. Things like assets, earnings, dividends, and, importantly, definite prospects. It's distinct from market prices, which can get distorted by, well, psychological excesses.
Market mood swings, basically.
Pretty much. Though they do admit the concept is elusive, you can't know the future perfectly.
Which leads directly to that safety net they talked about.
The margin of safety.
Yeah.
Absolutely vital. The idea is simple. You only buy when the price is significantly below your calculated intrinsic value.
That gap, that cushion.
That's what protects you. It compensates for the unavoidable indistinctness, as they put it, in any valuation. You need room to be wrong.
What strikes me is how relevant their complaints still feel. They wrote that in 1934 about analysts then who thought balance sheet values were entirely out of the picture.
And here we are 90 years later, and honestly, it feels like not much has changed for many people.
Still obsessed with the income statement.
Totally. Valuation talk is dominated by P/E ratios, sometimes applied, quite loosely. And Graham and Dodd were already getting worried about ratios like price to EBIT and EBITDA. They call them pernicious.
Pernicious, that's strong language. Why did they see EBIT and EBITDA as so bad? They're everywhere now.
Well, pernicious because they actively divert your attention from the anchor of the business, the actual stuff it owns, the tangible assets. EBIT and EBITDA, they strip out costs essential for keeping the business going.
Like depreciation.
Right. Depreciation and amortization, which reflect the cost of replacing assets over time. And interest expense, which reflects how the business is financed, its capital structure.
So by ignoring those, you're ignoring how much it costs to maintain the engine and who actually owns the engine.
You got it. You can make a company look incredibly profitable on paper without asking those fundamental questions. It's like admiring the wallpaper without checking if the walls are crumbling.
Amazing they saw that trend starting 90 years ago. So they laid out clear reasons why the balance sheet is essential. What were those?
Okay, 4 key things. First, it tells you the quantity and nature of the resources the business actually uses. These are the basis for returns.
And what you might get back if things go wrong, like in liquidation.
Exactly. Second, those resources help you analyze income stability. Think about it. Super high returns on capital. That screams opportunity to competitors.
So competition comes in, drives down returns. Makes sense.
Conversely, if a business is earning really low returns, maybe selling below its asset value, it might actually attract less competition. That could allow it to eventually recover, maybe restore a normal rate of profit. The asset base provides a sort of gravitational pull on earnings.
Okay, number 3.
The liability side. It's your window into the company's financial condition. Lots of short-term debt. That's a warning sign for potential debilitating financial distress.
A small hiccup in earnings could become a big problem if you can't roll over that debt.
Precisely. And fourth, the balance sheet acts as a check on earnings quality because it's a snapshot at a point in time.
Less wiggle room for creative accounting than with flows like revenue.
That was their argument. They saw it as fundamentally more reliable, less prone to manipulation than things like quarterly earnings reports.
Okay, so once you actually look at the balance sheet, you often see this huge gap between book value and market price.
That extraordinary divergence, as they called it.
Right.
And that's where the real work for a value investor begins.
It's the hunting ground. And Graham and Dodd gave us specific ways to measure asset value, focusing purely on tangible stuff, right? No goodwill, no brand names included here.
Correct. Strictly tangible. The first metric is just basic book value, or tangible asset value.
How's that calculated again?
You take total tangible assets and subtract all liabilities and any claims, like preferred stock, that come ahead of the common stock. A quick way is often common stock equity plus surplus minus intangibles, then divide by shares.
But you mentioned a detail there about preferred stock. That's where the thorough analysis comes in.
Absolutely. You can't just take the value written on the balance sheet for preferred stock liability. You need the effective par value.
Meaning what the preferred shareholders are actually entitled to.
Exactly. What's their real contractual claim if the company dissolves? They used Island Creek Coal as an example. Preferred stock was listed at $1 par value on the books.
Right.
But its actual dissolution value was $120 per share. So the analyst has to deduct the $120, or maybe $100 depending on the terms, not the $1. It's like a mortgage. You need the real amount owed, not just an accounting label.
Got it. That makes a huge difference. What about the other 2 asset values?
They get even more conservative. Current asset value is just the current assets, cash, receivables, inventory, minus all liabilities and prior claims.
And the last one?
Cash asset value. Even stricter. Just cash and cash equivalents, minus all liabilities and prior claims. Basically, what's left if you only count the most liquid stuff.
And that current asset value is often used as a proxy for a liquidation value.
Generally, yes. They considered it a rough index. And when estimating actual liquidation value, they had a really conservative rule.
Let me guess, assume the worst.
Pretty much. Assume the liabilities are real, but the value of the assets must be questioned. Trust the debts, doubt the assets.
A healthy skepticism. Did they give any guidelines for those asset values in liquidation?
They did. as rough averages. Cash assets, obviously 100%. Receivables, maybe 80% on average. Inventory took the biggest hit, they suggested, around 66 and 2/3%, reflecting how hard it can be to sell off goods quickly under pressure.
Wow, quite a haircut. And using these strict methods is how they found those famous net nets, right? Companies selling for less than their net current assets.
Exactly. Those were companies selling below current assets minus all liabilities. Deep bargains. They found plenty in the 30s, but noted they became much rarer later.
Why did those disappear, mostly?
Mainly due to general prosperity after the war, which lifted most boats, and also changes in tax laws that made quick liquidation gains less appealing.
Okay, so if those super cheap net nets are mostly gone, how does this apply today? We can't just wait for another Great Depression fire sale.
Right. For businesses that are actually viable, not on death's door, the analysis needs to evolve a bit. You move from pure liquidation value towards replacement value.
Replacement value. What does that tell us?
It's a check on earnings sustainability. If a company seems to be making huge profits relative to the cost of its assets way above the cost of capital, what's going to happen?
Competitors will want a piece of that action. They'll build similar assets.
Precisely. And that competition will drive down profits. Replacement value acts as that reality check. Is this level of profitability sustainable given how much it would cost someone else to replicate the business?
They had that great example with aluminum fabricators.
Yeah, fantastic illustration. Market prices implied existing aluminum capacity was worth, say, over $1,000 per ton per year. But guess what? That was also roughly the cost to build new capacity.
So naturally,
Everyone rushed to build. New capacity flooded the market, earnings tanked industry-wide, and those investments soured. Analyzing the replacement costs could have warned investors.
okay, that makes sense. Assets act as a brake on runaway earnings. But what about intangibles? If we exclude goodwill, but so many modern businesses rely on brands, software, R&D, how do we value the replacement cost of those?
It's definitely trickier, Graham and Dodd acknowledge that, but we can estimate. You can look at historical R&D spending to get a sense of what it costs to develop a product line or technology.
Okay.
And crucially, you use private market transactions. If a competitor, say, buys a similar brand in a private deal for 50 cents on the dollar of sales.
That gives you a benchmark for what your own in-house brand might cost to replicate.
Exactly. It's using real-world deals as a proxy for that intangible replacement cost.
So when you put the asset value analysis together with the earnings analysis, you end up in one of three situations.
Right. Scenario 1. Asset value is clearly greater than what the earnings power suggests.
Meaning the assets aren't being used well, or maybe not used at all, needs a shakeup.
Yep. Classic activist situation. Unlock the value stuck in the assets.
Scenario 2. Earnings value is way higher than the tangible asset value.
That suggests the company needs strong protections. Moats, as Buffett calls them. Maybe a unique brand, a patent, a network effect. Something to stop competitors from easily replicating those high returns, like the aluminum guys couldn't.
And scenario 3.
Earnings value and asset value are roughly in line. This is often the typical situation for a reasonably managed company without unique, impenetrable barriers. That alignment gives you confidence the earnings are realistic and sustainable.
Let's make this concrete. WorldCom feels like the perfect, if painful, example of ignoring the balance sheet.
Oh, absolutely. A textbook case of how this analysis could have saved investors huge amounts of money.
Remind us of the numbers, mid-1999.
Market value was soaring $125 billion. But the book value, only $51.2 billion. And here's the kicker.
A composition of that book value.
Over 85% of it was goodwill and other intangibles, stuff acquired in previous deals, basically air.
85%. So the actual tangible stuff backing that $125 billion market cap was tiny in comparison.
Tiny. If you strip out the intangibles, the ratio of market value to tangible net equity was over 15. That's flag number 1. Paying 15 times the value of the actual stuff for a telecom company facing, as Graham noted, vigorous price competition. That's pure speculation by their standards.
Put that in simple terms. It's like paying, what, $3 million for a house that's physically worth $200,000 just because you think rents will go up forever, even if the house crumbles.
It's a pretty good analogy. It just doesn't hold up under scrutiny. And the balance sheet kept waving red flags over time. Look at 1999 to 2000.
What happened then?
In a property, plant, and equipment, the hard assets jumped by 27%. They spent about $8 billion adding stuff. But revenues only grew 8% in that same period.
Uh-oh. Spending way more on assets than you're getting back in immediate revenue growth.
Exactly. Massive capital spending while revenue growth is slowing down. That should make you seriously question management's judgment and capital allocation skills, even before any fraud.
And then 2001?
The short-term debt on the balance sheet basically disappears. Poof. But it's replaced by $12.5 billion in new long-term debt.
Not necessarily a good sign.
Not at all. It looked like they were scrambling, kicking the can down the road, locking in long-term financing because maybe they couldn't handle the short-term pressure, especially with revenue starting to decline. It screamed desperation, not strength.
So the takeaway is stark. If investors had just done that basic Graham and Dodd balance sheet check,
they would have seen enough warning signs to avoid both its stock and bonds as investments unlikely to provide either protection of principal or promise of a satisfactory return. The balance sheet was sounding the alarm long before the accounting fraud blew up.
Which brings us to this really interesting paradox they pointed out. When a stock consistently sells for less than its liquidation value.
The logic seems simple, right? Either the price is too low or the company should be liquidated. One of those has to be true.
But they often aren't liquidated, even when they seem worth more dead than alive. Why does that happen?
Well, think about it from management's perspective. Liquidation means
loss of job, loss of prestige, a loss of control over all that capital.
Exactly. Graham and Dodd were pretty blunt. It's scarcely to be expected that the paid officers will consider the question from the standpoint solely of what is in the best interest of the owners. Their self-interest often conflicts with the owners.
And management often gets away with it because of, well, that famous quote.
Ah, yes. The typical American stockholder is the most docile and apathetic animal in captivity. A bit harsh, maybe, but it highlights the issue of shareholder inaction.
But when that apathy is overcome, real value can be unlocked. They gave examples.
They did. Mohawk Mining Company. Late 1931, stocks at $11. Management finally decides to liquidate. What happens?
They paid out $28.50 per share over the next few years. That's $17.50 more than the market price.
Incredible. And Standard Oil of Nebraska. Early 1939, stocks at $6. Management tries a lowball offer. It fails. Then Standard Oil of Indiana steps in.
Offers $17.50 a share, nearly triples the value for shareholders who were stuck holding something worth way less than its assets on paper.
These examples just show that sometimes the real intrinsic value is sitting there in the assets, even if the current earnings don't reflect it. It just needs a catalyst.
And they also touched on an ethical point about share buybacks, didn't they? When management uses company money to buy shares cheaply in the market.
Yeah, they question that, using the White Motor example. If management knows the stock is cheap because of hidden asset value or future prospects, and they use corporate funds to buy from existing shareholders in the open market,
they're kind of benefiting from the selling shareholders' lack of information or maybe their need to sell?
Right. It benefits the managers and remaining shareholders at the expense of the one who sells. It highlights that tension between management acting in their own best interest versus all shareholders' best interests.
So wrapping this up, this deep dive really hammers home that the balance sheet isn't just boring accounting. It's fundamental.
It's your reality check. It provides that anchor for safety, solvency, and a way to judge if the earnings story actually makes sense relative to the resources employed.
It cannot be ignored.
Absolutely not. And that leads to the final, really provocative thought Graham and Dodd left us with, something for you, the listener, to consider. The decision to keep running an unprofitable or underperforming business. Fundamentally, that's an ownership problem, not just a management one.
Meaning it's the shareholders' capital that's tied up?
Precisely. So the question you have to ask is, how much capital in companies selling below their tangible value, cash, property, factories, is just sitting there, maybe immobilized, because management prefers the prestige or job security over maximizing your return and safety?
That's a tough question.
It is. And the follow-up is, if you realize your capital is being underutilized or trapped like that, what should you, as an informed, non-apathetic stockholder, actually do about it? Answering that is maybe the ultimate test of applying these principles. Welcome to the Deep Dive. Our mission today, we're taking a foundational piece of wisdom, a really classic text, breaking it down into something you can actually use. We are diving into part 7 of Graham and Dodd's huge work, Security Analysis. This is the section called Additional Aspects of Security Analysis, Discrepancies Between Price and Value. Now, when you look at the commentary, this part gets called the value investor's equivalent of Deuteronomy, which feels about right because, everyone talks about the idea of value investing, but honestly, not many people have really, dug deep into this text. It's dense stuff.
It really is. It's that classic gap between knowing the path and walking the path, isn't it? And that's what we want to help you with today. We're pulling out the lessons that still hold up, even though this was written decades ago. We're focusing on that core question. Why do market prices so often disconnect from, actual intrinsic value? And crucially, how does a smart, disciplined analyst take advantage of those disconnects? Because look, the tools change, markets evolve, sure, but the way companies are run, the way people, investors, managers react in certain situations, that stuff, it pretty much stays the same.
That sets things up perfectly.
Yeah.
So let's start right there. If we're talking about financial success, what did Graham and Dodd actually see as defining a successful investor? Is it about growth stocks? Market timing?
No, fundamentally, it's none of those labels. Their core argument is that any strategy that works consistently over the long haul, it has to be based on a value approach. Whether you call yourself value, growth, momentum, whatever. It doesn't matter. You have to be comparing the price you pay to the underlying worth. Are you paying less for this thing than it's actually worth, either right now or based on a predictable future? If yes, then you've got a solid foundation. All those categories we use, they're really just oversimplifications. They kind of distract from that central idea.
Okay, let's unpack this a bit.
Right.
Because if the principle is that straightforward pay less than it's worth, why is it so hard? Why do so many people fail at it? This brings us right to what our sources call the great illusion. What is that?
The illusion. It's basically driven by how easy everything looks today. And let's be honest, a bit of ego too. I mean, think about it. Online trading, cheap software. Placing a trade is as easy as ordering, groceries online.
Like buying a book on Amazon. Yeah.
Yeah.
Quick, done.
Exactly. And that ease creates this persistent belief that getting rich is easy, that you can do it with minimal effort. It's the siren song of quick money.
And that illusion leads directly to those crazy market extremes we see, right? Like the dot-com bubble or the big corporate debt meltdowns later on. Money just sloshes around based on hype, not real analysis.
Precisely.
Yeah.
And Graham and Dodd saw this pattern way back, long before the internet. They pushed back hard against that illusion, emphasizing the sheer rigor needed. They wrote something like, since we have emphasized that analysis will lead to a positive conclusion only in the exceptional case, which is already a big statement. It follows that many securities must be examined before one is found that has real possibilities, mainly by hard and systematic work.
Hard and systematic work. Not exactly the get-rich-quick dream. That's the antidote. And you definitely need that rigor when you start looking at how companies are actually run, right? Let's shift gears into that darker side of finance. Graham and Dodd were warning about corporate shenanigans and conflicts of interest decades ago, but it sounds incredibly relevant today.
Oh, it's timeless. Absolutely. They spent a lot of time calling out, the often questionable standards of investment bankers back then. They saw the built-in conflicts, the clever, sometimes hidden ways bankers increase their own take, often at the expense of the average investor putting up the capital.
The numbers they mentioned from that era are just, wow. They talked about underwriting spreads, the fee the bankers take for selling stock being like 20% for one company, American Bantam Car, 20%. A fifth of the money raised just vanished into fees before the company saw a dime.
It's outrageous, isn't it? But what worried them even more was the concealed cost. They called it the warrant artifice. They used the example of Petroleum Corporation of America back in 1929. So the public pays $34 a share, the company. It only gets $31. That $3 difference is the banker's fee, the financing cost.
Okay, so the public's already paying a premium just for the banker's service.
Yeah.
But that wasn't all, was it?
Not even close. On top of that $3 fee, the organizers, the insiders, they got warrants. Basically, options to buy another 1.6 million shares later, usually at a favorable price. Graham and Dodd figured out these warrants immediately sucked away about 1/6 of the value from the common stock that the public just bought. So you add up the warrants, the financing fees. They estimated that the total cost of just setting up the company and paying management absorbed maybe 25, even 30% of the money the public put in. And a lot of that cost was kind of hidden within that warrant structure.
So hang on. They were basically saying way back then that things like modern stock options are a dangerous device for diluting stock values, that they take value from existing shareholders without showing up clearly as an expense. They were way ahead of the accountants on that one.
Miles ahead. They understood the economics of dilution far better than many people do, even today, frankly. And it wasn't just warrants. They also went after what they called corporate pyramiding. This is that financial engineering trick where a small group can control a massive company with very, very little of their own money actually at risk.
Right, control without the downside. What was the most extreme example they pointed to?
Oh, the Van Swearingen brothers. It's a classic. Through this complex web of holding companies, they ended up controlling almost 49.6% of the nickel plate railroad. But here's the kicker. their own actual equity in that whole empire. It was something like 0.7%, just a tiny fraction.
Wait, 0.7%.
Yep, 0.7%. Think about that. They controlled nearly half the railroad's assets, making huge decisions, but their personal financial skin in the game was almost nothing.
Wow, so nearly 50% voting power, but less than 1% of the financial risk if things went bad. You can see why that leads to really risky, unsound decisions. The managers get the upside, but the public shareholders bear almost all the downside. That kind of structural greed.
Yeah, you can see why security analysis still matters.
Exactly. And that idea of hidden risks and skewed incentives transitions really nicely into the modern world, even with things like derivatives they couldn't have imagined. Graham and Dodd couldn't predict today's complex options and futures markets, obviously, but the core lesson about understanding the game and figuring out who the patsy is, that's timeless.
Right. I think Chapter 46 on warrants is mentioned as being the most dated because the options market was so undeveloped then. So what's the key lesson about derivatives that still hits home?
It's really about avoiding superficial knowledge. There's a great anecdote from David Abrams about learning the box trade early in his career.
Yeah.
It's this classic options arbitrage strategy. You buy and sell a specific combination of calls and puts.
Right, different strike prices. Exactly. And mathematically, because of how options are priced, it should guarantee you a small fixed profit at expiration, like maybe $5 per spread or something.
Okay, sounds like free money. Why would doing that make you the patsy? Seems smart.
Because if you, as a relative newcomer, think you've stumbled onto guaranteed free money in a hyper-competitive market, you're almost certainly missing something. Abrams realized he was just executing a simple formula. He didn't grasp the nuances, the friction costs, the timing risks, the cost of capital, all the things the pros did understand. They were likely taking the other side of his guaranteed trade and making more money off him somehow.
Which leads right to that famous Warren Buffett quote.
Ah, the poker game quote.
Yeah. If you've been in the poker game for 30 minutes and you don't know who the patsy is, you're the patsy. You need deep understanding, not just surface knowledge.
So the takeaway is, yeah, complexity creates opportunities in finance, but only if you've really done your homework. And the really big wins, they often come from finding compound mispricings. What does that mean? That's where things get really interesting. It's when both the underlying the stock, the bond, the index, and the derivative based on it are mispriced, usually undervalued. Think about the Japanese Nikkei index back in the late 1980s. The index itself was just wildly, absurdly overvalued, a huge bubble. Smart investors saw this, but they also noticed that options traders were selling puts, the right to sell the index in the future really cheaply, like unreasonably cheap insurance. So they bought that cheap insurance, those puts, on an index they were convinced was going to crater.
Double leverage. You're betting against something overvalued using a tool that's undervalued itself. And we saw the same thing play out in the 2007 crisis, didn't we?
We did, absolutely. With credit default, swapped CDSs on those subprime mortgage bonds. The bonds themselves were toxic, way riskier than advertised. But the CDSs, the insurance against them defaulting, were priced too cheaply because the market models massively underestimated the real risk. So guys like Michael Burry and others, they bought that cheap CDS protection. When the whole thing collapsed, the value of those CDSs exploded, sometimes increasing by 50, 60 times the initial amount they put at risk.
It's just incredible. And these kinds of spectacular opportunities, they keep happening, despite everyone talking about efficient markets. You mentioned some more recent examples, too.
Yeah, even outside of derivatives. Look at the corporate bond market around, say, 2002, after the dot-com bust. There was so much fear. You could buy bonds like the AES 10.25% senior subordinated notes for maybe 15 cents on the dollar. That's a yield of almost 66%.
66% yield. That sounds like distressed debt, like they were about to go bankrupt.
That's what the market thought. But guess what? AES never missed an interest payment, and those bonds were actually called back at full face value 100 cents on the dollar within about a year. Or go way back to Graham and Dodd's time, 1938. A&P, the Great Atlantic and Pacific Tea Company, huge retailer, biggest in the world then. Its stock was selling for less than its net current assets, less than the cash in inventory minus all liabilities, basically less than its liquidation value while still being a massive operating business.
So the market was valuing the whole ongoing company at less than zero.
Pretty much. That great illusion, that cycle of fear and greed, it just keeps creating these chances for people who are willing to look past the noise and do the work.
Okay, so that leads us to the how. How did Graham and Dodd actually suggest analysts go about systematically finding these weird deviations? This is the hard, systematic work part.
Right. In Chapter 50, they really lay out two main methods. The The first one is comparative analysis. This is basically lining up companies in the same industry, say steel companies or railroads, and comparing their key financial metrics, their ratios. You're looking for the outliers. You want to find the ones that, as they put it, deviate widely from the modal exhibit.
What does that mean, modal exhibit? Like the average?
Yeah, essentially the industry average or the typical profile for a company in that sector. You look for the ones that stick out, either way better or way worse on certain metrics relative to their price. But, and this is important, they warned you have to compare like with like. You can't really compare, say, Rock Island Railroad, which had a ton of debt and was speculatively financed, with Union Pacific, which was much more conservative. Their finances were just too different. They'd react completely differently to like a recession. So apples to apples.
Makes sense. Okay, what was the second main method they recommended?
The second was looking for asked earnings anomalies. This is about digging into company reports to find businesses selling at really low prices compared to their earnings power or compared to their net current asset value, that liquidation value we just talked about. They were especially keen on finding what they called Group A stocks. These were the holy grail, really.
Group A?
Yeah, stocks that met both criteria, selling for less than, say, 7 times their annual earnings and selling for less than their net current assets, getting that double discount. That strongly suggests the market is just completely overlooking the company or is gripped by totally irrational fear.
So it's all about the numbers, the data, the comparisons.
Yeah.
Which is a stark contrast to what most people on Wall Street seem to do, which is forecasting. Try to predict the market, predict next quarter's earnings. Why were Graham and Dodd so down on that approach?
Because it's incredibly dangerous. Their point was the current market price already reflects what everyone thinks is going to happen. It's the consensus view baked in. So if you buy SLAP just because you think, oh, next year's earnings look good, you're facing 2 big risks. First, your forecast could just be flat out wrong. Happens all the time. And second, even if you're right about the earnings, the stock price might already be reflecting that optimism, maybe even over-reflecting it. You're basically trying to outguess the collective wisdom or madness of the crowd, often against pros with way more information. It's just not a reliable game to play.
And that leads directly to the most famous concept from the book, right? The ultimate safety net.
Yeah.
The margin of safety.
Absolutely. That's the bedrock. The distinction they make is critical. If you're just doing market analysis forecasting, there's no real safety margin. You're either right or you're wrong. And if you're wrong, you lose money. Simple as that. But security analysis, the Graham and Dodd way, insists on that margin of safety. You buy only when the calculated intrinsic value is well above the price you're paying. That gap, that cushion, protects you. It protects you from bad luck, from errors in your own analysis, from unforeseen events, from all the stuff you can't predict.
Okay, so wrapping up, what was their advice specifically for the average person, the small investor listening to this? How should they approach things?
Well, back in 1940, for safety and just steady income, they actually recommended U.S. government savings bonds. Yields were decent then, often better than top corporate bonds. Boring, but safe. For actually trying to make a profit, though, their advice was pretty clear. Stay away from brand new companies, IPOs, that kind of thing. Avoid actively trading in and out. Instead, focus your energy on finding those genuinely undervalued securities, using the systematic methods we talked about. And this is key. They suggested submitting your analysis, your findings, for critique by someone more experienced. Don't just rely on your own judgment in isolation. Get feedback.
That's great advice. So this whole deep dive, it really hammers home the need for discipline over illusion, hard work over hype, spotting that timeless corporate opportunism, and above all, demanding that margin of safety. I guess the ultimate message from the sources is, look at the numbers, dig into the facts, and crucially, think for yourself.
That's it. Independent thought. It's the only way to consistently avoid being the patsy in the market game. You know, the whole academic debate about whether markets are efficient or not, it's kind of died down. Or maybe the people actually making money exploiting the inefficiencies are just too busy doing it to argue anymore. That great illusion. It's alive and well. And that means there are still plenty of opportunities for anyone willing to do the hard, sometimes boring, often tedious work of real value investing.
So here's a final thought we want to leave you with, really challenging that persistent illusion. If markets were truly rational, truly efficient all the time, why does human psychology, our collective fear, our greed, that constant desire for easy money, keep creating these huge, often predictable mispricings decade after decade? Something to think about. Happy hunting.